Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with the weekly news. And of course, that means Nick Bendel is here with us. Hello, Nick.
Well, hello, Owen. Great to see you again.
Yes, it's amazing. It's another week goes by and Nick pops up again. Anything interesting happened in the past week for you?
Oh, yes, it has been an interesting, eventful, productive week. I don't want to tell you everything because that would take several hours and that would bore the listeners. I'm just going to focus on one thing. My Business Hunter and Scribe, we write content for finance and property professionals throughout Australia. One of the things we do is award submissions. We're very good at writing award submissions. Many of our clients have been nominated as national finalists over the years and have won awards too. And a buyer's agent we wrote an award submission for recently gave us this 5-star Google review. With the world moving to AI writing everything, it is refreshing to come across a rhetoric who can take your experience and knowledge, ask the right questions, and put that into a written masterpiece. Thank you, Nick Bendel, for your writing. I will let you know if I win.
Cool. Congratulations. I know, yes, you are very good at writing those, which is why I always give you credit for winning instead of your clients.
You are too kind, but I give them the credit. I'm kind of like the icing on the cake.
Yes. Okay. I can live with that. Yes, the past week for us here at Leafield has been a productive one. We've had another staff member start with us today, so that's good. So after all of the busyness of the first half of this year, we're now fully staffed again, and so looking forward to being able to move on and start growing and with getting all the work done and being productive. But in the past week, I do have to say, I forgot to say it at the start, Happy New Year. It's 1st of July. Happy financial new year, just to clarify for those people who don't know what I'm talking about. This is what happens when you grow up with a father as an accountant. The 1st of July is always a more festive Happy New Year than the 1st of January. But in our world, yes, end of financial year is a thing as well. So just like end of month, end of financial year is like that plus a little bit more. Yes, everyone asking for the end of financial year statements so that they can get everything ready for their tax time and accountant. So yes, it's always a busy time of year just after 30 June. But apart from that, Nick, you've got 3 stories for us, I assume.
3 very interesting stories, actually, and I'm looking forward to hearing your thoughts. The first one is Perth market stabilises as vendor discounting triples. The proportion of Perth vendors selling their homes at a discount has risen sharply, from 10% in early 2026 to 30% by June, according to the Real Estate Institute of WA. REWA President Suzanne Brown said the shift reflected a market adjusting to a meaningful change in the supply-demand balance. A surge in new listings since late March had given buyers significantly more choice after a prolonged period of tight supply, she said, while the federal budget had dampened investor demand. Notably, the average gap between listing price and sale price narrowed sharply from 6.5% in the March quarter to just 1% in the June quarter. This change does not suggest prices are falling, but more that we are seeing the market stabilise and the rate of price growth slow, Brown said. Interesting, Owen. So around 30% of Perth vendors are now selling below their initial asking price, compared with around about 10% a few months ago. How significant is that shift?
Well, it is a shift, but I wouldn't say the sky's quite falling in just yet. It's to be expected with the slowdown in the property market overall. I think the Perth market will be quite resilient. Yes, nothing to get too worried about at this point.
Suzanne Brown, the Real World president, she also made a note that this reflects market stabilisation rather than falling prices. So the two of you appear to be in lockstep there. I'm wondering, do you think it's possible? Was Perth has more than doubled in price over the past 5 years. Do you think it's possible that Perth prices will start going backwards sometime this year?
Oh, it's you might see some properties, some areas go backwards. Overall, I mean, it's without calling it, because it might technically go into a negative at some point. I think it'll remain fairly flat in general. You'll always get pockets that are going backwards. Some will go forwards. And it just depends how the cookie crumbles at the end of the day.
Well, prices can't go up forever. Sooner or later, they'll stop rising. Maybe they'll go backwards for a bit. Maybe they'll remain flat, but they can't rise forever. I'm wondering first, do you think we're near a peak? And if Perth is close to peaking, I'm wondering, how should people feel if they're bought into the market in 2026, potentially near that peak?
Anyone buying a property, especially for investment, needs to understand that they're buying for a long term. Anyone trying to buy a property expecting to make 20, 30, 40% in a short period of time, yes, is even though it might have happened, you need to have your own crystal ball that is guaranteed to work to make sure that that comes through, and that just doesn't exist. So anyone making a serious purchase like this needs to make sure that they're buying for the long term, and they're not relying on capital growth to be their one and only savior. So property investment is a vehicle for investment for a number of reasons, but people might be buying to be able to live in as well. It's as long as they're not caught with being in negative equity. That's the main thing. So make sure you've got a good deposit. Yes, I feel for those people that were got caught up in the 5%, government scheme, federal government scheme to get into a property. They're the people that can really get hurt. Which is why I've never been a fan of these government schemes that are pushing people that aren't really in a financial position to get into the market.
Our second story today is a continuation of the SMSF issue, which we discussed last week.
Yeah.
SMSF ban may undermine new housing supply, economist warns. Ray White Group chief economist Nerida Conisbee has warned that the federal government's decision to ban new SMSF borrowing for residential property could have a much bigger impact on housing supply than official figures suggest. The government has argued the policy is relatively minor because existing borrowing arrangements will be grandfathered. Commercial property borrowing remains permitted. And new SMSF residential borrowing accounts for less than 1% of total residential lending. However, Conisbee said that that assessment overlooks the important role SMSF buyers can play in helping new housing projects get off the ground. She explained that developers often rely on pre-sales to secure construction finance, and SMSF buyers frequently commit to purchasing properties well before a project is completed. While those purchases may not appear in Australian Taxation Office data until settlement, they can be crucial in convincing lenders that a development is financially viable. Conisbee said SMSF buyers are particularly active in new apartments, townhouses, house and land packages, and other investor-focused developments, where achieving sufficient pre-sales can already be challenging. Owen, Nerida Conisbee made the point that removing SMSF investors from the market will make it harder for developers to get projects approved. I'm wondering, well, what do you make of her argument?
Um, while I agree with her sentiment that yes, any pre-sales for any reduction in pre-sales for developers to be able to get their finance is going to hurt them. To say though that self-managed super funds are a major buyer of brand new properties is in my experience, just incorrect. So I'm not sure. Maybe Nerida's been talking to the Ray White Projects division about what they do, and I don't know what their goals are in terms of how they get their sales. But if they've been targeting self-managed super funds to get their sales up in the projects division, then yeah, that's for them. But with all of the advisors that we work with, who work with brand new properties, most of them don't work with self-managed super fund clients because it's considered to be a bit higher risk to buy off the plan in your super fund. And so it's just something that they don't go near. But the message that she's getting across is absolutely correct in terms of it'll take more supply out of the market for renters, but probably more in the established property side of things. And in mature markets where there can't be a lot more supply put into the market, then you're going to see rents increase quite dramatically because of investors not having that incentive to be able to buy existing dwellings, and even more so with super funds. And again, the tax benefits of negative gearing in super funds aren't that beneficial. So it's not that big a deal for super fund buyers to buy brand new. So yeah.
Well, to the extent that investors do want to buy new builds, now they can't borrow and do that through their SMSF. But I'm wondering,
Correct.
are we potentially going to see an increase in investors doing that outside super, given that negative gearing benefits will still be available for new builds?
I mean, possibly. It's really. I mean, anyone that's buying for tax benefits, for negative gearing benefits, is really not buying an investment property for the right reason. But if they want to get the benefits of that are there, and they want to buy brand new, then think of it as a bonus, really. But buying a property just for tax benefits is usually not the right strategy.
Well, let me press you a little bit further on this.
Sure.
What do you think of the idea that the government should allow people to buy resi property through SMSFs as long as they buy new builds? And that way, investors would be able to buy resi homes as part of their retirement plan and stimulate the home building sector at the same time. Would that be a good compromise?
Yes, I think it would be, but there'd have to be some changes made to being able to make it easier for super funds to be able to do that. Because there's further risks involved with doing that, because you might be buying off the plan, 12 months, 18 months, even up to 3 years off the plan in some instances. So you might be tying up a cash deposit. And also, life can change in anywhere up to 3 years. So what if you don't qualify for the loan at that stage because your job situation has changed? So that's where it can be a little bit more risky. So there needs to be a a no recourse situation for them to be able to commit to a purchase in super, but get out without any recourse if for certain reasons, like if the finance wasn't approved.
Well, for our final story, we'll take things in a different direction. Buyer's agent outlines strategies for manufacturing equity in a cooling market. With property markets softening across much of the country, investors who wait passively for capital growth may be waiting a while, but there are strategies available to those willing to be more active. Pinnacle Buyers Agents founder Michael Lazarja identified 3 approaches investors could use to manufacture equity rather than simply waiting for the market to deliver it. The first is targeting properties in lower socioeconomic areas where purchase prices and holding costs are lower. That way, investors could build a portfolio while minimizing negative cash flow. The second is renovation. Lazarja said cosmetic improvements could meaningfully lift a property's value, particularly if the investor did some of the work themselves. If you buy a good asset and you can put in a bit of sweat equity, that is the faster, more accelerated way to extract that equity to buy your next one, he said. The third strategy is deliberately targeting properties with flaws, a busy road, proximity to a train line, for example, which can be acquired at discounts of up to 20% below market value. Lazarja cautioned, however, that such assets carry a meaningful risk. They can be difficult to sell quickly if circumstances change. So let's look at those 3 strategies one by one, Owen. What do you think of the idea of buying lower price properties in order to minimize negative cash flow?
Yeah, well, I mean, all of these have their potential negatives, and it's in terms of buying lower price properties. Let's call it in the bottom sort of 25 percentile of price properties. You're usually looking in lower socioeconomic areas, or you're looking at properties that have significant issues, either repairs and maintenance issues, defect issues, and so there can be extra costs there for repairs and maintenance, maybe even bigger renovation issues. And lower socioeconomic areas can come with their own issues from a cash flow point of view. They might get a higher return, but quite often there can be potential issues with tenants who have difficulty with keeping up with their rent for whatever reason, and because it's a more low income area. So all of those things you need to weigh up and decide whether that's a good strategy for where you're looking at taking your investments, and you need to be prepared for them. So it means you need to have extra money sitting there as a buffer, as a bit of a float, to be able to weather any storms that come up, whether it be repairs and maintenance or some vacancy or some issues. And you've got to make sure you've got insurance, or your insurance is in place and so on. But people don't realize that when something goes wrong, you have to cop the negative cash flow at that point in time until the issue is resolved, and then you can make claims on insurance and all those types of things. So having significant buffers, no matter what type of property you're buying, is always important. So it's while this strategy can work, you need to be prepared for the ups and downs.
Okay, I think you've explained the pros and cons very well. Let's look at the second one, the idea of manufacturing equity through renovating, especially if the investors are going to do the work themselves. What do you think of that strategy?
Oh, it's a great strategy, but you need to be handy, or you need to have some tradies in the family, or a good group of mates who are tradies. So if you're a tradie yourself, and you can do the work yourself, and you can manufacture that equity, because the biggest cost with renovating nowadays is that labour cost. And then also waiting to get someone who can actually do the work and will do the work. And yes, but those costs have gone up quite significantly, which has made this strategy not as easy as it used to be in, say, 10 years ago.
Yes, very well said. And the third strategy, and this one was interesting, targeting subpar properties. For example, they might be on a busy road or near a train line. In order to buy them below market value, Lazar just suggested you might be able to get the property up to 20% below market value. What do you think of that idea?
Well, these types of properties, if they're on a main road or something like that, if you're typically looking at them being at least 10 to 20% below what you would consider, the median, value in the suburb. So you're not really buying below market value. You're just paying market value for that type of property. What you're probably better off doing is, in these times where if you're looking to pick up a bit of a bargain, yes, there might be someone who's a bit just having a bit of a distress sale. If it's not, if you can pick up a property that doesn't have these major issues that would normally be considered subpar, but it might still need some work done, but you can pick it up and they're not on a main road, and you can pick that up a bit under market value, then that's probably the better strategy long term, because yes, these subpar properties like main road properties can have a lot of issues with selling down the track. And if you're wanting to rent them out, you usually have to rent them out at 20% below market rate as well. So you're not really getting a return there. But if you want to buy in a particular suburb and you want that suburb and you want that address, then maybe the strategy is to buy a main road property, and that can get you into the suburb. So it all depends on what your end goal is and your long-term goal is.
Now, I should mention Lazaja, he was speaking on the Smart Property Investment podcast, and he wasn't personally endorsing that strategy. He was just putting it out there as an option, and he certainly explained that it came with a range of downsides that people needed to be aware of. One that comes to mind is those sorts of C-grade properties. They're so hard to sell during a downturn. When the market is booming, people will buy anything. But if the market is not booming, I guess the vast majority of the time the market is not booming. It's either going backwards or it's flat or it's going up a little bit. Having those C-grade properties, you're not feeling too clever at that point in time.
No, so it's it can be an issue in the short term if you end up having issues yourself from a cash flow point of view. You need to spend money on it. You'll always get hurt on valuations. If you want to get it revalued to be able to pull out equity, to be able to do more renovations and that type of thing. So but if it comes down to the address, and maybe if you're going to live there at the property and you need it for schools or whatever that might be, then that can be a good option. But as an investment property, if you want good tenants and you want good consistent income, then main road properties aren't the best. If you can pick up good reno property that you can get in and do the work yourself, or you've got some good trades that you've used before that can get in and get the work done, then that's probably the best strategy if if you've got that ability to get the work in done quickly.
Well, great discussion. Really enjoyed hearing your views as always, Owen. Thank you so much. Looking forward to chatting again next week.
No worries. Thanks, Nick, and we'll see you again in a week's time. See ya.